Maxis. Maxis Berhad, commonly known as Maxis, is a prominent telecommunication service provider based in Malaysia. Founded in 1993 by Tan Sri Ananda Krishnan, the company initially operated under the name Binariang Berhad until it rebranded to Maxis in 1999. It commenced commercial operation in 1995 and has since grown to become one of the largest telecommunication company in the country, offering a wide array of services including mobile, fixed line, and broadband internet service. The company headquarters are at Kuala Lumpur. The service they are provide is mobile and fixed line telecommunication, broadband, and various value-added service. Their market position is Maxis is recognized as the leading mobile operator in Malaysia, boasting millions of subscribers across both prepaid and postpaid segment. Axiata. Axiata Group Berhad, commonly referred to as Axiata, is a leading telecommunication conglomerate based in Malaysia, with a significant presence across Asia. Established on June 12, 1992, originally as AM International Berhad, Axiata was rebranded in 2009 to reflect its broader ambition and focus on emerging markets in the ASEAN and South Asia region. Company overview: the headquarters are at Kuala Lumpur, Malaysia. The operation for Axiata actually operate in multiple countries include Malaysia, Indonesia, Sri Lanka, Bangladesh, Cambodia, and has interest in non-mobile telecommunication sector in Thailand and Pakistan. Subscriber base: the group serve over 162.5 million customers across its market, making it one of the largest telecommunication networks in Asia.
Now I will explain about horizontal balance Axiata. The horizontal analysis of Axiata balance sheet from 2018 to 2023 reveals significant trends and change in the company's financial position. On the asset side, there has been a notable decline in cash and short-term investment, which fell by 38% in 2023 compared to 2022. This trend follows a sharp rise of 64% between 2019 and 2020, but shows a steady decrease afterward. Account receivable experienced considerable fluctuation with a 40% drop in 2023 after a substantial 61% increase in 2022. Prepaid expenses demonstrated steady growth over the years, increasing by 6% in 2023, which total current asset declined by 28% in 2023, indicating weakened liquidity. The company has steadily invested in property, plant, and equipment, with a 5% rise in 2023, driven primarily by machinery and equipment. On the liability side, account payable decreased by 20% in 2023, following minor fluctuation in earlier years, reflecting changes in the company's payment cycle. However, short-term debt surged by 166% in 2023, suggesting an increased reliance on short-term borrowing. Total current liabilities fell by 28%, partly due to a significant reduction in the other current liabilities. Long-term debt showed consistent growth, rising by 19% in 2023, indicating a strategic focus on long-term financing. In terms of equity, retained earnings declined by 20% in 2023, possibly due to reduced profitability or higher dividend payouts. Other equity components, such as translation, adjustment, and unrealized losses, showed fluctuation that contributed to the overall volatility. The equity decreased by 8% in 2023, reflecting a slight erosion of shareholders' value. Overall, the analysis highlights challenge in liquidity as cash and receivable decline sharply in 2023, while the company increasing reliance on debt, especially short-term borrowing, raises concern about financial stability. However, steady investment in long-term assets like property, plant, and equipment could enhance future productivity, while the decline in equity underscores the need to bolster shareholder confidence. Horizontal analysis of income Axiata provides insight into the financial performance of the company over multiple years, comparing percentage change in revenue, expenses, and net income from 2018 to 2023. Revenue has shown fluctuation with a 10% increase in 2023 compared to 2022 after experiencing stagnation in 2022 and a decline in 2021. The total cost of revenue has increased by 5% in 2023, which, while significant, is lower than the growth in revenue, leading to a 12% improvement in gross profit. Operating expenses, including selling, general and administrative expenses, increased by 12% in 2023, reversing the downward trend observed in previous years. Depreciation and amortization costs also rose significantly by 15% in 2023, indicating higher capital investment. Unusual expenses, including impairment costs, showed mixed results, with some declining sharply, such as impairment of assets held for sale, while others fluctuated significantly. Interest and investment income showed extreme volatility, with investment income decreasing by 137% in 2023, indicating a higher interest expenses or lower return on investment. The net interest expense surged by 146%, reflecting increased borrowing costs. Net income performance is concerning, as the company reported a loss nearly $2 billion in 2023, a drastic decline of 120% from 2022, when it had a net profit of around $9.7 billion. This was largely due to discontinued operation and extraordinary losses amounting to $1.87 billion. The drastic decline in net income suggests significant financial challenges, possibly due to restructuring effort and external economic pressure. Overall, while revenue growth in 2023 was strong, rising costs and non-operating losses have significantly impacted profitability. The company must address increasing investment and interest expenses and extraordinary losses to stabilize its financial position moving forward.
So, I will present about the vertical income analysis of Axiata. The vertical income analysis of Axiata measure each income statement component as a percentage of total revenue, offering insight into cost efficiency and profitability trends over time. From 2019 to 2023, revenue fluctuation reflected market dynamics, while the cost of revenue remained relatively stable, impacting the gross profit margin, a key indicator of profitability. Axiata's ability to manage operating expenses, EBITDA and net income as a percentage of revenue determines overall financial health, with a rising net income margin signaling improved cost and control efficiency. By examining this trend, stakeholders can assess Axiata's financial performance, identify cost management effectiveness, and compare its profitability with industry benchmarker. That's all. Thank you. So next, I will present about the vertical balance analysis of Axiata. The vertical balance analysis of Axiata's balance sheet presents each financial component as a percentage of total assets, helping to understand the company's financial structure and trends over time. Key areas included cash and short-term investment, which indicate Axiata's liquidity position. The proportion of cash to total asset fluctuate yearly, reflecting change in financial strategy and cash management. Accounts receivable, both gross and net show how much the company is owed by the customer, with net receivable adjusting for doubtful account and the provision for doubtful accounts, which appear as a negative value, represent the estimated losses from uncollected payments. A higher provision may indicate increased credit risk. By analyzing this component as a percentage of total assets, vertical balance analysis helps assess liquidity, financial stability, and risk exposure over time.
Assalamualaikum, my name is Muhammad Hazwan bin Halim. My numeric is 2023114177. Okay, next we move to Maxis ratio. Maxis struggles with liquidity as its current and quick ratio are consistently below 1, meaning it may have a trouble paying short-term liabilities, negative net working capital, though improving from negative 2,774 million in 2019 to negative 2,381 million in 2023, highlight ongoing cash flow issue. Maxis is relying more on debt, with its long-term debt to equity ratio increasing from 1.25 in 2019 to 1.55 in 2023. While this raised financial risk, the liabilities to asset ratio has remained stable at about 75%, showing a balanced financial structure. Efficiency is mixed. Days receivable outstanding have worsened from 331 days in 2021 to 963 days in 2023, showing slower customer payment. Inventory management has improved slightly, but faster supplier payment are adding pressure on cash flow. The cash conversion cycle has lengthened with 957 days net in 2023, reflecting extended working capital challenge. Despite this challenge, Maxis remains profitable. Return on asset is stable at 16%, showing efficient use of resource. Return on equity has grown from 53% in 2019 to 64% in 2023, providing strong shareholder return. Okay, next we move to Axiata ratio. Axiata liquidity ratios highlight persistence challenge, with current and quick ratio consistently below 1, reflecting difficulty meeting short-term obligations. Although net working capital has improved from negative 14,812 million in 2019 to negative 4,590 million in 2023. It remains deeply negative, signaling liabilities significantly outweigh assets. The solvency ratio reveals increasing reliance on debt as the long-term debt to equity ratio grows from 1.03 in 2019 to 1.46 in 2023. However, liabilities to assets remain stable around 0.71 to 0.75, indicating no drastic structural shift. Efficiency ratio show mixed trends. Day receivable outstanding worsened to 182 days in 2023, while inventory turnover improved, with days inventory outstanding decreasing from 12 to 17 days over the period. Day payables outstanding reached 263 days in 2023, extending supplier payment periods and leaving the next day financing required negative. Profitability has declined with return on asset falling from 11.35% in 2019 to 6.90% in 2023, and return on equity dropping from 46.68% to 24.52%, reflecting weakened shareholder return. So, we move to the next part.
Which one should I invest between Maxis and Axiata? Maxis is the better investment for me if you prioritize stability, consistent dividends, and lower financial risk, while Axiata offers higher growth potential but comes with greater risk due to its international exposure and higher debt level. Maxis has a strong market position in Malaysia with steady revenue, better cost efficiency, and a history of consistent dividend payouts, making it ideal for investors seeking reliable returns. In contrast, Axiata expansion across multiple countries present opportunities for long-term growth but also expose to economic fluctuation and currency risk. If you prefer lower risk and stable returns, Maxis is the best choice. But if you can tolerate some risk for potential high reward, Axiata could be worth considering.